Pinduoduo and Baidu are two Chinese stocks I've had rated as a buy for over a year now. If you didn't already know, Pinduoduo is home to the company Temu, which is incredibly popular in the United States, but it's going to be impacted by the removal of the de minimis provision, which allowed companies to import goods from outside the US if they're under $800 without paying a tariff. Now that revision is removed, and that's going to impact Temu negatively. And I've already seen prices on the platform increase in response. Baidu, meanwhile, I think of as the Alphabet of China. It operates similar businesses as Alphabet. It also has a driverless car division, and so it reminds me a lot of that company as well. Interestingly, the economy in China has performed relatively well despite the tariffs that the United States placed on the country. So the businesses and the country overall, the economy is holding up well, surprising to me. So in this video, I'm going to compare these two Chinese stocks and answer which one I think makes the better buy at current market prices. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. The first thing I wanted to compare these companies on is revenue growth over the previous decade, and they've both done a phenomenal job increasing revenue meaningfully, but Pinduoduo has increased much quicker, especially since 2022, growing from 18.9 billion up to 57.2 billion. Baidu, meanwhile, has grown its revenue from 10.2 billion to 18.5 billion, so Pinduoduo growing revenue much quicker than Baidu. However, that revision to the de minimis provision and the impact of tariffs is likely to hurt Pinduoduo more so than Baidu. The next thing I wanted to compare these two companies on is the net profit margin, and they both improved meaningfully, but Pinduoduo more so, with the net profit margin at 23.9%, slightly above Baidu's net profit margin of 21%, but Pinduoduo is improving. However, if you go back to 2022, from 24% to 23.9%, the margins haven't improved by all that much. Pinduoduo invested aggressively in marketing and sales and promotions and incentives to increase the popularity of Temu. I remember there's a website I formerly used. I believe it was called Ebates, which gives you a percentage cashback on your purchases. And for Temu, the percentage cashback had reached 20% cashback on your purchases. And Temu's products were already so much cheaper than they were on Amazon. Recently, I visited that cashback website again because I like to check on that to see how promotional companies have become. It's a little kind of marketing channel that companies use that allows them to lower prices without making really widespread uh, price cuts and discounts. And those rates have declined meaningfully for Pinduoduo. They're not offering as large of promotions and cash back on those websites and platforms that I'm visiting. So the next thing I wanted to compare these companies on is the return on invested capital. Again, Pinduoduo doing much better in this regard, 71.8%. Those are remarkable ROIC figures compared to Baidu at just 5%. This is a huge advantage for Pinduoduo, and one that I think they will be able to maintain. Even though these de minimis provisions have been removed, the company can still generate better ROIC than Baidu, which has a long and significant disadvantage to make up. All right, lastly, I wanted to compare these two companies on valuation. And when measuring by the forward price to earnings ratio, Baidu is trading at a forward PE of 14.2 compared to Pinduoduo, which is trading at a forward PE of 12.2. They both look undervalued at these market valuations, and I have them both rated as a buy, and I've had them rated as a buy for over a year now, and they're already up over roughly 30% here in 2025, so I'm happy to see this positive performance. So if I had to pick one of these two to buy today, I would pick Pinduoduo as the better stock because of the better revenue growth and the better ROIC. It also comes with a great risk now as to how US consumers will respond to the higher cost of goods on the platforms buying these products. By the way, the charts you saw me retrieving were from fiscal.ai, which is my preferred data provider. There's a link in the description for their services. If you use my affiliate link, you'll get a discount and you'll get a free trial to their service. They save me so much time in collecting and aggregating financial information. And on top of that, they provide information that I may not be able to find anywhere else, such as segment specific information about companies like Amazon's web services segment or Alphabet's cloud services segment. These are data that they manually input and research, and I find them to be incredibly helpful. So to reiterate, Pinduoduo would be my choice here as the better stock to buy, but I have them both rated as a buy. And of course, every stock comes with a risk. Do your own due diligence before making any investment decisions.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.